Silicon Valley Bank collapse. Apparently, they're touting this as one of the biggest collapses. Signature Bank has collapsed. Yesterday, when we're kind of looking at the news stories and like, well, this is the one that we should look at. There were stories of like all the trading was stopped on almost any financial institution. Trading on the stock market was halted because they didn't want to, run on the money and run on the banks and all that sort of stuff. Today, it's a little bit of a different story because they reactivated, and some of those shares went skyrocket, and they had to halt trading again because of fear of pandemonium again on the other extreme. There's a lot of stuff. There's a lot of uncertainty. There's a lot of turmoil. First of all, Dr. Rod, can you actually explain to us what this actually is? Because there's a little bit, because obviously we spoke recently about, these crypto failures and stuff like that. And those tended to be more around more poor management, where this one seems to be maybe not quite so much poor management and definitely not as extreme as in 2008. So what is actually happening? Why can a bank go bankrupt, and what's actually happening in this situation?
Well, there are two or three things going on here, but of course, a bank is a business. So like any business, a bank can actually go bankrupt. And that will happen, of course, when the market value of their assets falls below the market value of their liabilities. So that's the simple explanation for what's going on. In terms of the big picture, a lot of this has to do with the way in which governments behaved during the global COVID pandemic and what central banks have been doing since to rein in inflation. Another factor here is that the banks that have closed their doors to date have generally focused on a fairly narrow set of assets. So they've been highly specialised banks. In some cases, they focus quite strongly on cryptocurrency exchanges. So they've been providing loans to cryptocurrency exchanges. Many of those have fallen on hard times. So two of the three banks that are in trouble have had a loan portfolio that's very heavily skewed towards cryptocurrency exchanges. Now, that's a problem. You should never put all your eggs in one basket, as we know. That's a golden rule for investors. On the other hand, one of the things that's happened for Silicon Valley Bank, of course, is that they held a lot of government debt. And as central banks have increased interest rates, the market value of that debt has plummeted. So not necessarily the result of poor management. Perhaps in hindsight, they've made some misjudgments. But I think a lot of this has to do with the way in which governments spent money as if it was going out of fashion during the COVID pandemic, and they haven't really reined in their expenditure since. And in order to cover government deficits, they've essentially printed money, and that's been going on all around the world. And the chickens are coming home to roost, so to speak, with high rates of inflation, and they are being tackled by the central banks through a process of raising interest rates. So
now let me just jump in there, because you actually said something earlier about that these banks are investing in government debt. And so in my research, I've been seeing, obviously everyone's talking about bonds and things like that here. And that seems to be, the bond seems to be the issue here. And I find it really interesting that it's very, I don't know whether speculative is the right way to say it, but it seems to be influenced by people's feelings and not a practical thing. Explain to us, what are those bonds and how do they impact, like, how is it actually affecting this situation now?
Yes, bonds and treasury bills and those kinds of assets, they are IOUs issued by governments when they overspend and choose to fund their overspending by literally printing money. They don't literally print cash, but it has the same effect. Now, those bonds, the government paper is regarded as risk-free. The trouble is it's only free of default risk, right? Because the government can simply print more money. It's not actually free of capital risk. Capital risk arises because interest rates can change. You see, on all the government debt has what we call a coupon rate of interest, and that's the explicit rate of interest that the government pays on that debt. Now,
and is that directly related to the Federal Reserve will release the federal interest rate? Is that directly related to that, or
it is related, because what the Federal Reserve System targets as the interest rate more or less becomes the base interest rate throughout the economy. But you see, with the coupon rate, that won't change for the life of that particular piece of government debt. Now, if interest rates are rising, then as new government debt is issued, it is actually paying a higher rate of interest. So that makes the second-hand government debt less valuable. And so the price of that second-hand government debt falls. So if a bank is trying to increase its liquidity by selling off some government debt, although there's no risk of default on the instrument itself, the capital value or the market value of that debt falls significantly. Now you can appreciate.
Can you explain that, but in dollar terms? So let's say I get a bond for $100 and the coupon rate was, let's say, what was it originally? It was like about 2%. Is that correct? What it was sitting at?
So if new government debt is being issued now at 4%, then that will almost halve the value of the government,
the existing
outstanding government debt, because the income stream's only half on the outstanding debt as the income stream on the new debt. The mathematics are not quite that simple, and it has a lot to do with demand for liquidity in the system and all sorts of things. But essentially, the second-hand debt, because it is paying a lower interest rate than the new government debt, it's just not worth as much when you try to sell it to somebody else on the markets.
And but that seems to be the issue, isn't it? The fact that the bond itself doesn't actually lose value. If you just hold it for its full term, you'll get the same amount for it. It only becomes an issue when things, how do I say, when there is this issue and they need to sell it and it is now worth less in comparison to.
That's true, but depending on the accounting system, or the accounting conventions that you have to apply as a bank, if you have to actually book the paper loss, then it really matters then as well.
Yeah.
But as far as Silicon Valley Bank is concerned, it's the second largest bank collapse in American history and therefore in world history. It really was the victim of the rapid rise in interest rates. Now, look, that wasn't predicted. All the central banks weren't predicting those rapid rises in interest rates, and the reason they didn't expect inflation to take off as it did, and the reason why they didn't expect inflation to take off as it did, is that they accepted what I believe is a faulty understanding of how the economy works. It's called modern monetary theory, which essentially says that a government can literally print money to pay its bills without creating inflation, because by spending in excess of its normal revenue, a government is actually going to stimulate economic activity. So supply increases as demand increases, and therefore prices won't increase. But old-fashioned economists like me don't see it quite that way. And if a government keeps spending, then you will definitely get some inflation. And the only way to avoid that inflation ultimately is for governments to stop the spending. So most people in the markets were surprised by the increases in inflation around the world. And that means that people weren't expecting interest rates to rise as quickly as they did. Therefore, they didn't see the capital risk involved in holding government debt. Nobody did. So I don't think this is an issue of the competency of management, certainly not at Silicon Valley Bank. Now, also, their loan portfolio was fairly concentrated because they focused on high tech and startups in particular. But look, their real issue is on the market value of the government debt that they held in their asset portfolio.
So explain to me, like, this, they talk about the run on the bank, right? The reason why they had to close is because everyone started asking for their money back and things like that. And apparently the CEO did a big sell-off or whatever. Like all of this for me is like it really, it's almost an accounting thing. Like you said, it's an accounting thing, because if they hold that bond, if everything just stays normal and like interest rates go up or whatever, but they keep that bond, like really they're earning the same amount that they were projecting anyway and everything like that. It's only the fact that now because the interest rates increase, inflation happens, now there's a bit of a run on the bank, or they need to sell more now to be able to fund their ongoing, or like
well, the point is,
how does all that play in?
They carry a loss because the market value of those government bonds has dropped. Whether or not they sell those bonds, the market value has dropped. Now, smart people realise that, and so they start selling shares short. So, in other words, they enter into transactions anticipating the shares are going to diminish in value. And so that has been going on for a few months now, because the smart people in the market realise that the bank was overweighted in terms of its asset portfolio, and that the market value of the government debt that it was holding had to fall as interest rates rose. Now, the thing is this, interest rates are still fairly low, but if you compare a 3% interest rate to a 1% interest rate, that's a 300% increase in interest rates, right?
Yeah.
So, in fact, in terms of the percentage increases in interest rates, they have been absolutely massive. Right?
Okay.
And my belief is that it surprised everybody, because the markets were lulled into a false sense of security based on modern monetary theory. They thought it was okay for governments to spend and to finance their expenditure by monetary means, because that would just stimulate supply. All of the incomes generated as companies produced, output would be spent, and so everything would be okay. But everything's not okay.
When there's one thing that I've heard spoken about a lot here is it realized loss or something like that, where they're talking about the fact that they actually haven't lost money, but according to their accounts, if they have to like sell, liquidate right now, then they actually have a loss.
That's correct. So they're not necessarily losing cash, but essentially accounting principles say we've got the value of a business is dependent upon what the market says are the values of the assets that they hold and the liabilities that they hold. When interest rates increase massively in terms of their multiplication, so from 1% to 3%, that still sounds like a low rate of interest, but you've got now something that used to be 100% is now 300%, so to speak. So there's been a massive increase in interest rates, and that must mean that the market value, whether they sell or not, of the government debt has fallen dramatically. And shareholders look at that. Potential lenders to the bank look at that and say, well, no, this bank might hold X billion dollars in treasury bonds and so on. But if we had to sell them off, they're not worth anything like they might be carried on the books at. That's the issue. When you look at the bank as a going concern, it doesn't look so healthy. And that's why people will sell short. So they will undertake transactions such that they can be ready to buy up very, very low cost shares a little bit into the future. So instead of, as it were, buying long and hanging on to shares for the future, they sell it. That's called going short, and that's been one of the things that's been happening in these markets. Look, one thing we do need to keep in mind is that since 2001, there have actually been over 560 bank failures in the United States. Okay.
Wow. How many was that?
Over 560.
Wow.
All right. Now, in 2021, 2022, there were no bank failures. In the few years before that, there are just a handful, 4, I think, in each of those years. I've written down the maximum was 157 banks went belly up in 2010. That was all part of the global financial crisis. Now, in terms of value, just the two banks, Silicon Valley Bank and Signature Bank, I think their combined value is about $319 billion. That's getting fairly close to the record in 2008, which I think was about $375 billion. So it's a lot of money. But look, the system isn't going to collapse. I know you can go online and you can find lots of podcasts full of doomsayers and who are saying the whole system's going to collapse, but they don't talk about the fact that the system has managed over 560 bank failures in the last 22, 23 years.
Hey, that was an excerpt from our On the Cube Leadership podcast. If you enjoyed it, give it a thumbs up, put a comment below. And if you want to see more content like this, faith-based leadership development content, make sure you check out our channel, give it a subscribe, and hit the bell notification so that you'll be notified when we release new content.